Welcome to session 2 of the Rebel Income Coaching Program. For this session, we're going to be talking about stock valuation and fundamental analysis. We're going to be diving into the metrics and the information that we like to use for the Rebel Income system in identifying the stocks that are available at attractive valuations and the fundamentals that drive them, and how we try to identify companies that have a book of business that justifies the value proposition that we're looking for. Let's dive straight into it. For most people who have been involved in the markets, there's a couple of different ways to think about investing and the different types of investing methods that are available. Two primary ones are growth investing and value investing. Now, as investing methods go, growth and value investing are often at polar opposites from each other. If you pay attention to market media experts, you try to follow the advice of well-known personalities like Jim Cramer, your your investments will almost invariably be oriented primarily around growth. Growth investing follows the simple premise that a stock that is already going up is likely to keep going up. It's an easy idea to wrap your head around, because if a company is experiencing attractive growth in its business, its stock should do the same for shareholders. On the other hand, for a lot of investors, value investing is counterintuitive, because rather than starting with a stock's price, it emphasizes a company's book of business, its fundamental strength. It also requires its followers, those who like to focus on value investing, to work a little bit harder to identify useful opportunities, since it evaluates what the company's business is worth. That means digging into details like earnings reports and other public disclosures, and then comparing that evaluation to a stock's current price. Some of the modern day proponents of value investing include widely successful investors like Warren Buffett, Charlie Munger, and Peter Lynch. We see Mr. Buffett here on the screen. Mr. Buffett himself often credits his success to the principles he learned as a student at Columbia University from his mentor, Benjamin Graham. Mr. Graham is commonly called the father of value investing. His book, The Intelligent Investor, which we see here, is considered the Bible of value investing principles. This book was first published in 1949, and it's never gone out of print. And in fact, it is one of the principal sources that we used to build the Rebel Income system. Let's talk a little bit more about how growth and value differ in terms of what kind of stock patterns you're going to tend to see. Because no matter whether you focus primarily on fundamentals, on valuation, those kinds of things, you still have to deal with the reality that stock prices vary from day to day, sometimes in very wide fashion. This is a stock chart of Apple Computer. And as we can see over the past year, it's seen some pretty wide swings between about $124 and $176 at a time. Excuse me. Growth investing focuses on the idea not only that a stock that is going up should continue to go up, but it also emphasizes primarily upward trends, as we see here in this case. Along the same lines, growth investing looks for opportunities within upward trends to try to take advantage of pullbacks and what is often referred to as buying the dip. Buying the dip would be something like from January to February, watching the stock go up, then begin to retrace down here through the end of February, find a level of support where it was able to reverse again, and bounce back up again. This opportunity is a classic kind of buy the dip opportunity that growth investors like to focus on. Now, this is functional, this is easy to identify, and can be effective in working with stocks as they follow these upward trends. The caveat is that, and the assumption that a lot of growth investors fall into, is that as the stock starts to reach historical highs, as Apple is doing right now, is that the stock is just simply going to continue to go higher. And the truth is that if it is able to break above this 52-week high that was established last August at around $176, it may continue to go up. And if it does, that's a good thing for growth investors. This assumption, though, however, is that the trend can continue into infinity, and that's an assumption that is actually a little bit flawed. We can see on this chart for Apple Computer. I'm just going to change the color on my pointer here and just demonstrate. We can see that trends can certainly move to extreme levels, but they inevitably reverse. They hit a stopping point. In this case, in August, this high around $176 acted as what we call resistance, and then the stock started to go down. It followed this downward trend all the way until January. It's easy to assume when the stock is in the middle of a downward trend that it's going to continue forever as well. But the truth is that all trends are finite, and that means that at some point that trend is going to stop. It did that here at the beginning of January around 124, reversed, and it went back up again. And that is what it's been doing for the most part ever since. The question then is where this next stopping point, this next level of resistance for this trend is going to be. Growth investing is going to look for a break above major points of resistance that have happened in the past. That's why the August peak in Apple was going to be kind of interesting. And it looks for opportunities to maximize the investment in those trends over long periods of time. The difference is with value investing is that we take a kind of the polar opposite approach. Value investing works with the understanding that all trends are finite, that they do inevitably, as we saw with the Apple chart, they do reverse. The opportunity for a value investor comes when the stock starts to approach historical lows. I've got a chart now here of Tyson chicken, and we can see that this is excuse me. We can see that this is a stock that has been following this downward trend for quite some time. However, it looks like it has found a major support point down here at around $56. This is a stopping point, what looks like a stopping point for now for this downward trend. And we can see that it's been moving a little bit gradually upward with a little bit of a break here at the end here of the chart. These are the kinds of opportunities that value investors like to look for, because the fact that the stock has been in a longer term downward trend increases the possibility and the likelihood that the stock is going to be available at an attractive value. So rather than trying to extend and look for stocks that are hovering at historical highs or making new highs, value investors tend to focus a little bit more on the opposite side of the equation. This is a kind of a contrarian view that understands that since all trends are finite, the best opportunities, the best buying opportunities in the stock market come when stocks reach the bottom of these long downward trends and begin to recover. These are the kinds of classic opportunities that we try to identify with the Rebel Income system. I mentioned just a few minutes ago that all trends are finite. What this means then is we understand that at some point, every trend, no matter how long it's gone on, will stop and reverse. And we've already identified some of these levels here with Apple over the course of the past year. Sometimes trends can extend for months, sometimes they can extend for years at a time. But the simple truth is, excuse me, that all trends, no matter how long they continue, inevitably at some point end. Here's an upward trend that came to an end. This is an end to a downward trend. This was a classic value kind of an value investing buying opportunity at this point at around 133 in June of last year. Here's another stopping point, another where the downward trend ended, that would have been more useful for a bargain hunter, a value investor, than for a growth investor. What we don't know yet is where this next top of this trend could be. It could well continue past 176. However, the likelihood and the odds begin to increase that the trend will end the longer it continues. We understand that all trends are finite, that they inevitably do end and reverse. Then we understand that the longer a trend extends through time, the higher it goes, the more it exceeds previous highs. At some point, people are going to begin to take profits. They're going to sell out of the stock, and when that begins to happen in large numbers, then those trends will inevitably reverse. Rebel Income is designed to try to identify those reversals and take advantage of them when the opportunity is right and when the value proposition looks attractive. Let's talk about valuation analysis for a moment and spend some time talking about some of the metrics that we've used to conduct our value analysis and identify the opportunities that we think represent the right kinds of buying opportunities for our system. Following the idea we mentioned in session 1, and that is kind of the basis of value investing everywhere, this idea that it is better to buy a good company at a fair price than a wonderful company at a high price. There's a lot of different metrics that you can use to try to think about what that means. How much should a good company actually be worth? One of the most useful metrics along these lines to begin the analysis process that we've learned to rely on is a company's book value. Book value, as described by Warren Buffett, is the value that shareholders will receive. It is quoted as a per share number. That is the value that shareholders will receive if a company were to close its books today, liquidate all of its assets, and pay off all of its obligations. The amount of money that is left at the end of all of that is what would go back to shareholders, and that is the book value. You can take that per share book value, compare it against the stock's current price, and that gives you a price to book ratio. With Rebel Income, we look not only at what the current price to book ratio is. Some analysts, some investors like to try to look for price to book ratios below 1. In other words, the book value of a company is equal to the stock's current price. So that if you can, the logic is, in that case, if the price to book ratio is less than 1, then the stock's price must be less than the actual value of the book of business. Now, there's some logic to that. The problem is that in reality, very few companies trade below their actual book values. The stock market is an emotional animal, and as investors recognize opportunities, whether they're value hunters or growth seekers, inevitably they tend to overprice stocks over time. And so instead of simply focus only on the current price to book ratio, we have found it useful to also compare the current ratio against historical price to book ratios for the stock. That way we get an idea of how the market generally treats the stock over time in good conditions, in bad conditions, bull markets, bear markets. Over time, the longer the period of time we can evaluate against, the more precise we feel the number is. And so we factor that into where we think a stock's value proposition starts. Now, that's not the only metric that we use. We also like to pay attention to cash flow and compare the stock's price against cash flow. Cash flow, like book value, can be translated into a per share number. Once it's translated into a per share number, then we can compare it against the price to get a similar price to cash flow ratio. The same process of comparing the current cash flow ratio against historical levels gives us another view of how the stock market tends to treat the company's stock price relative to how much the company is actually worth. Not only what the book value is, what the intrinsic value of the company may be, but also in terms of what is actually happening right now, in terms of cash flow, what is left after all expenditures are paid, what does that represent in terms of a value for the business, and how does the stock's current price relate against that? So when we take those two together and combine them, we feel that we get a broader view of what that valuation is likely to be. We use those primary two metrics then to derive our own what I like to call the Rebel Income fair value target price. Now, the idea here is that when we combine those two, we would like to see the stock's current price at least 20%, 15 to 20% under normal circumstances below that fair value target price. The closer it is to that fair value, the more that we believe that it is not undervalued. If it is higher than that fair value price, and the stock is overvalued and will generally not be considered for the trades that we publish on our website for Rebel Income. But if it is below that fair value, then it is something that we're going to take into serious consideration for the trades that we do publish and make available. We also make sure to share exactly where we think that fair value target is on every trade that we publish on our website. You will see a paragraph included in the highlight, very much like what you see here, where we tell you what we think the fair value target is and what that means for the stock's current valuation. In this case, this was a recent trade in the Rebel Income system that we made on a stock symbol CTRA that is more than is undervalued by more than 127%, which means that the potential long-term opportunity is more than twice as high as the stock's current price. That is not actually very typical to find. That's a little bit rare, but it is certainly interesting when it does happen. But what we're trying to find, our general target, is about 15 to 20% upside from the stock's current price. Now, as we dive into the details, we are still beyond the valuation metrics. We want to try to actually look at the company's book of business and see if the fundamentals really support the fair value target that our valuation analysis has identified. We like to start with earnings per share and revenue growth. These are numbers that are easily available and readily referenced from a variety of websites. But the comparison that we like to look for is to compare the most recent quarter to the previous year in both cases. For the example that I have on the screen right now, you can see that in the case of earnings per share in the previous quarter, earnings grew almost 85, a little over 85, 83.5%, excuse me, and over the previous year, almost 40%. Those are very interesting numbers. Again, not necessarily expected. I'm not saying that we're looking for these kinds of numbers as rules, but we are looking to see that earnings per share are growing on both a yearly basis and in the most recent quarter under ideal circumstances. In the same way, we like to see that sales are also growing so that we can begin to infer that the earnings growth we're seeing is sustainable. If we see earnings growth when sales are actually declining, then that implies the company is being very aggressive about the way that it may be managing costs, but that is also generally not a sustainable trend. So positive sales growth with positive EPS growth work together to provide a more solid financial basis and fundamental basis to work from. In the example here, we can see over the last 12 months, sales grew a little over 44%, and in the previous quarter, a little over 11%. That's interesting. But these are the kinds of patterns that we want to try to look for, mostly positive patterns, without focusing necessarily on exactly what the level of growth may be. One other note that is that's worth mentioning, again, this is not necessarily a requirement for the Rebel income system, but one of the things that is also be interesting is to compare the rate of EPS growth to sales growth. Let's use the quarterly number. We have 83.58% for EPS growth in the previous quarter and a little over 11.3% growth in sales in the last quarter. When earnings per share growth, is above sales growth for the same period, then the implication is that the company and its management team is being really effective at trying to maximize all of their operations so that they can get as much profitability out of their business as possible. And so this is a favorable relationship that under ideal circumstances we like to see. It's not always required, because the truth is that business can be variable, it can be very cyclical, and sometimes these best case scenarios are simply out of the company's control due to economic forces, industry forces, unforeseen events, all kinds of things. If we look at the previous year, we can see an example of what I'm saying. We have sales growing a little over 44%, while EPS growth was about 40%, so a little bit less. These are interesting growth numbers, but they also diverge from the ideal pattern where what we want to see is that EPS growth is growing faster than sales growth. That is as an ideal circumstance and condition. Okay. Another way that is really interesting and useful to look at a company's profitability is by focusing on net income and revenue. While I appreciate being able to look at earnings per share and the way that it grows, going back to this slide, one of the things, and I mentioned this in session 1 about earnings per share, is that it's a number that can be very highly variable. It can be calculated using a number of different accounting methods. That doesn't mean those methods are wrong. It doesn't mean they're shady or illegal by any stretch, but it does mean that they can be subject to interpretation and are a little bit harder for me to trust for purposes of the Rebel income system. Now, that's why I like to look at some of these other numbers as well, is to see if they support the summary that I'm seeing by a pattern of EPS growth. Net income is simply the amount of income that is left after a company has paid all of its obligations. So making the same comparison to whether or not net income is growing over time in similar fashion to EPS is a way to try to see if that earnings per share picture holds up, or if it is something that is different. Now, looking at it on a graph is one thing. We can see how net income changes from quarter to quarter, from year to year, based on what kind of a time period we're looking for. But the method that I like to try to use for doing this is relatively simple. Get my pen again, just a moment. What I like to do is to try to turn net income into a percentage of sales. So this is the trailing 12-month number that we have here. So I'm going to take 14.3 billion, and I'm going to divide it by 91,056 billion. Let's just walk through that calculation right now. 14385 divide by 91056, and that gives us about 15.7% net income to revenue as a percentage. We'll round that up to 15.8%. Okay. I can do the same evaluation, the same calculation on a quarterly basis. If I see that the number on a quarterly basis matches, or it possibly even exceeds the percentage number for the trailing 12-month period, then I have a good indication that profitability is improving, or that it is, whether it's stable, improving, or possibly declining. So in this case, we have 4.9 billion divided by 26.7 billion. Let's go ahead and do that math. 4991 divided by 26,749, and we get 18.6%. Sorry, 18.6%. So we can see that the net income over the last quarter grew. Profitability, the company's profit margins in effect grew over the last quarter compared to the trailing 12-month number. This is a good indication that management works very hard to be very efficient, to try to manage costs, and to run its business as excuse me, as thoroughly as possible and as conservatively as possible. All right. That's net income. Free cash flow is another way that we can try to measure a company's profitability. We do it a little bit differently. And in this case, what we're simply looking for is a consistent pattern of growth over the last year. Now we can do that just simply by looking at each of the previous quarters. And we can see from March of 2022 to June of 2022, it was up. From June of 2022 to September, up. From September to December of 2022, up. From December to March of 2023, also up. So this is a continuous and consistent pattern of increasing cash flow that confirms the pattern that we just saw with net income, where profitability is improving. This is a strong sign of fundamental strength. Now, some people might look at these differences from one quarter to the next and evaluate the pace of the increase, and I understand that. For purposes of Rebel Income, however, we're a little bit more conservative. All we're really looking for is the overall increase over the past 4 quarters. This is also a number that we'll make sure to publish on in our Rebel Income trades. We will let you know as for every stock that we highlight for a trade exactly what their cash flow looks like. We also provide a number that I like to call free cash flow yield. This just simply is a mathematical calculation that divides the current free cash flow number by the company's market cap to give you an idea of what the free cash flow yield is. The idea here is simply that higher is better. Under ideal circumstances, free cash flow yield above 10% is considered to be very, very healthy. If we see free cash flow yield below that level, it's not always categorically a negative thing. It may mean that the company's growth is a little bit more conservative, but that will certainly not disqualify the stock from being considered for the Rebel Income system, as long as we are seeing useful free cash flow in terms of yield and practical growth on a quarterly basis. One of the questions that always has to be answered, no matter whether we're talking about personal finance or certainly corporate, is the way that debt is managed. Now, as consumers, we are indoctrinated with a belief and an understanding that debt is bad and should be minimized and avoided as much as possible. The reality in the corporate world, however, is a little bit different. Debt is not categorically bad because it is a way that a lot of companies use to finance important operations, research and development, strategic acquisitions, expansion. A number of other things can be facilitated by the proper use of debt. So debt in and of itself is not a bad thing, but the way that a company manages its debt, how much debt it has, and what kind of a burden it may or may not represent against the company's overall operations is something that we do want to pay attention to. We start by looking at a company's debt to equity ratio. Now, this number is something that is calculated through a number of other data feeds on the web. The general idea is that a debt to equity ratio above 1 implies that a company is highly leveraged. As much as possible, the preference then is to see debt to equity ratios below 1. The lower the better, the more conservative the approach to debt generally is in those cases. But a lot of industries rely very heavily on debt, and so this is not categorically a disqualifier. Beyond the debt to equity, beyond the simple ratio, we do want to get a more thorough look at what the actual debt is. For the company that I'm using for this example, we can see not only that debt is very high, more than 173 billion, but also that it has been increasing over the last 5 quarters on a very steady basis. That could be something that could represent a risk because of the fact that debt to equity is very high, the fact that debt has been rising steadily over the past year. Again, that depends on the industry. For example, some industries like finance, autos, and even a lot of pharmaceutical companies operate with fairly high levels of leverage, which are is to say they have high levels of debt. So it doesn't automatically mean that this is an unmanageable number. Comparing this against the numbers that we have already evaluated, going back to the company's free cash flow, for example, and seeing that free cash flow is increasing with more attractive, is not only increasing, but is increasing sizably, along with the increasing pattern of the increasing profitability coming from net income. These are things that may suggest that the company's ability to service their debt is not a risk. And so even with high debt in that case, this may not be a risk automatically. This is why we consider all of these things together, is to try to put in perspective what their financial strength really looks like. The next thing that I like to consider against the question of debt then is its level of actual cash and liquid assets. These are numbers that are pulled straight from a company's balance sheet. And so these are not calculated numbers by market analysts or by market websites. These come straight out of their earnings reports. We can see a pattern of cash and equivalent increase or decrease over time in a variety of different ways. But the thing that matters the most in terms of Rebel income and the numbers that we're trying to pay attention to is to see what the company's actual cash and equivalents are. In this case, we can see not only that over the last 4 quarters, cash has been increasing. It did drop, we can see, from March to June of last year, but from that point it has been increasing on a relatively steady plane, but also that it is very, very high relative to the amount of debt that the company is carrying. Let me go back to that slide. Excuse me. Apologize. So we have the current number for long-term debt is almost 175 billion, but total cash is in excess almost it's nearly 320 billion by comparison. So the balance sheet implies that the company could liquidate all of their long-term debt straight out of cash. They also have very healthy free cash flow and increasing profit margins, which implies there's no risk that this high level of debt could not be serviced. These are some ways that we can try to really drill down into a company that we think could have an attractive valuation and represent a good opportunity to actually be a functional trade in the Rebel income system. You'll see me write about all of these elements in each trade that I highlight. In the next session, let's just talk for a moment, kind of give you a little bit of a teaser of what is coming up next. In session 3, we're going to talk some more about stock charts and price action and recognizing trends, reversal points. We're going to spend some time going over the Traders Pro charting tool and some of the different resources that it provides for you to help you identify things like reversal points and trends, and some of the different ways that you can leverage the information on the Traders Pro website to find useful investing opportunities. We'll also focus on pivot analysis and talk about how identifying things like support and resistance and how they change over time lead to and develop trends, and how trends actually reverse, and what are the things that that precipitate those reversals, and how those represent the right kinds of opportunities at different points depending on what your investing system is. We'll also fold all of that into an evaluation of where these patterns fit properly into the Rebel income system, the kind of patterns that we typically are trying to look for and to take advantage of. Thanks for your time. I hope you found this useful. We'll see you in the next session.